Today, I want to start with a statement that might sound a little provocative. Most of the investment channels and personal finance content you've watched before, you probably got it wrong from the very first step. Yes, you heard that right. The first thing most people do when they start learning about investing is to rush straight into the stock market. And usually they do it after listening to all kinds of so-called gurus online, chasing the hottest stocks and the most hyped-up mutual funds. What is that like? It's like a brand new gamer who just registered an account, skipped the beginner's tutorial, doesn't even know the basic controls, and somehow teleports straight to the final boss. What do you think will happen? Most likely they'll get one shot by the boss, lose all their gear, lose all confidence, and end up trapped at the very top of the mountain, unable to move ever again. Now, think about it. When we play games, we all know to start in the beginner's village, fighting straw dummies or baby boars, to learn the basic rules and mechanics. When we're in school, teachers always tell us to solve the easy problems first before tackling the hard ones. But why is it that we all understand this simple logic, and yet completely forget it when it comes to investing, something that involves our real, hard-earned money? In today's session, I want to fix that, once and for all. We're going to dig into why most people get the very first lesson of investing completely wrong, and what the real correct path toward financial freedom actually looks like. This isn't just about learning a few techniques. It's about reshaping the entire way you think about investing. When you open an account with a brokerage or buy a financial product from a bank, you've definitely done one thing: the investor risk assessment. Financial institutions will ask about your age, income, family situation, and debt level. Then they'll assign you a risk profile, something like conservative, moderate, or aggressive. It's a standard compliance process. But here's the strange part. Most people forget about it the moment they finish it. No matter if you're labeled conservative or moderate, you probably turn right around and dive straight into the riskiest, most speculative corner of the market. Short-term speculation, chasing market hotspots, completely goes against the basic laws of finance. The financial market is like a structured ladder, or you could think of it as a video game with different level maps. At the lowest risk level, you have treasury reverse repos. Then come bonds, convertible bonds, value stocks, growth stocks, and finally, the most volatile areas: concept stocks, futures, and options. It's supposed to be a gradual process, climbing step by step up that ladder. But in reality, countless people skip all the lower levels and parachute straight to the top, joining a zero-sum game where everyone's cutting each other's throats. I've been down that road myself. When I first started investing, I was obsessed with limit-up chasing, buying stocks that had just hit their daily price limit. I did it for about a year, and the result? I lost half of my capital. At that time, I was earning just over 5,000 yuan a month. I put 40,000 into the market and lost 20,000. That lesson hurt, a lot. But luckily, I didn't keep listening to so-called stock tips from others. Instead, I turned to books to find real authoritative knowledge. The first book I found was Security Analysis by Benjamin Graham, often called the Bible of Value Investing, and its structure completely woke me up. Guess what the first section of this legendary book on security analysis talks about? It's not stocks, it's bonds. Graham spends pages upon pages dissecting the principles, valuation, and risks of bonds. Only after that does he build the logic for analyzing stocks, step by step, from the foundation of fixed income. He teaches investors how to analyze a company the same way you'd analyze a bond, to find stocks trading below their intrinsic value, and then patiently wait for the price to return to fair value. Warren Buffett learned his very first investing lesson from Graham. That single foundation taught him what true conservatism means, the power of the margin of safety, and it's what allowed him to survive through countless market storms over the decades, eventually becoming a legend. But if, from the very beginning, your mind is filled only with candlestick charts, market themes, insider tips, and trading tricks, then your entire investment house is built on quicksand. Your worldview slowly becomes distorted, until you fall into what I call financial nihilism. You stop believing in real value, thinking every price move is just manipulation or human greed at play. And that, taking the wrong first step, is the scariest part, because it destroys your chance of success from the very foundation. So what should be the very first lesson in proper investing? The answer is, learn low-risk investing. Why? Because it's simple, and it allows room for error. Even a complete beginner can do it right and earn their first easy money. That amount might not be huge, but the positive feedback it gives you is priceless. It helps you start developing the ability to manage your personal finances. And more importantly, it builds your confidence that wealth can actually grow through wisdom. Secondly, and this is crucial, the greatest truths are often the simplest. Those plain, low-risk investment methods usually carry the most fundamental principles of value investing. They form the foundation of the entire financial system. Like I said before, after losing money on momentum trading, I went back to common sense. So, what did I do? It was very simple. Step 1. I put my entire monthly salary into a money market fund that offered a decent return at that time. Step 2. I applied for a few credit cards and used them for all my daily spending. That's the simplest form of risk-free arbitrage an ordinary person can do. During the interest-free period on the credit cards, my salary was sitting in the fund, earning daily interest. Back then, I'd see an extra few dollars in my account every day, a few hundred by the end of the month. It made me genuinely happy. That money wasn't much, but it was earned through knowledge and discipline, not luck or gambling. Later, when I was no longer satisfied with just earning a few bucks a day, I took the next step. I started studying bonds, learning about bond funds, and even trading some corporate bonds directly in the secondary market. At that point, I wasn't afraid of price drops anymore, because I knew the bonds I chose had very low volatility. Even if the market panicked and dropped 1 or 2% in a day, I was only losing what I had previously gained from the money market fund. My principal was safe, and my mindset completely changed. As a result, in just a few months, I earned over 10% returns in the bond market, a market most people completely ignore. That successful experience gave me the confidence to take on slightly higher risks. So I moved into the convertible bond market, a hybrid asset that combines the downside protection of bonds with the upside potential of stocks. After that came undervalued value stocks like utilities and coal companies. See the pattern? This was a very natural, step-by-step expansion of my risk appetite. Every move I made was built upon the knowledge, capital, and insights I had gained from the previous step. I always made sure I understood the value of the assets I invested in, and I always ensured I could handle the worst possible outcome. That's the right path for anyone starting their journey from zero. You might say, all of this sounds too small scale. Can I really achieve financial freedom this way? Of course you can. Next, I'll share 3 real-life cases from different markets, people I've either met or studied deeply, who truly started their journey to financial freedom through low-risk investing. In China's value investing community, there's an investor whose ID many people might recognize. Super Lu Dingong. I first came across him on a now-defunct online forum called Top Bond Forum. At that time, I had just started learning about bond investing, and I actually made money following some of his analyses. Since then, I've kept an eye on his work. He started out in fixed income arbitrage, bonds, convertible bonds, closed-end funds, and structured funds. Back then, the bond market offered a huge advantage for individual investors, a strategy nicknamed eating the institution's leftovers. What did that mean? Many institutional funds had strict risk control rules written into their contracts. For example, they were only allowed to hold AAA-rated bonds. If a bond issuer experienced temporary business troubles, the rating agency might downgrade the bond from AAA to AA. According to the contract, the fund manager was then required to sell the bond immediately, no matter the price. Because the bond market has far less liquidity than the stock market, these forced, large-scale sell-offs would often push a bond with a face value of $100, one that was almost certain to pay back principal and interest, down to $90, $80, or even $60 to $70. For retail investors who understood the company's fundamentals and believed it wouldn't actually default, this was a goldmine. Institutions were forced to take losses due to compliance rules, while we could calmly pick up those bloody chips at a discount. That's one of the most classic scenes in value investing, when prices fall far below intrinsic value because of irrational market behavior. Later, as bond investing became less accessible for retail investors and the guaranteed repayment system broke down, this path became harder to walk. So Lu Dingong transitioned into the stock market. But his stock-picking mindset still followed that same low-risk, high-certainty bond-like logic. One of his most famous trades was a pair trade between two hydropower stocks. In China's A-share market, there are two companies, SDIC Power Holdings and Sichuan Investment Energy. Their core asset is the same, the Yalong River Hydropower Station. SDIC Power owns 51%, while Sichuan Investment Energy owns 49%. In theory, their market capitalization should stay very close to that 51 to 49 ratio, but short-term market sentiment often causes their prices to deviate. What did Lu Dingong do? He held both stocks. When SDIC Power's price rose more and the ratio widened, he sold some SDIC Power shares and used that cash to buy the cheaper Sichuan Investment Energy. When the price spread narrowed again, he switched back. He called this process moving bricks between stocks. By doing this repeatedly, he accumulated more and more shares during bear markets. When the hydropower sector later entered a major bull run and prices multiplied, he earned double returns. One from the extra shares he had accumulated through brick moving, and another from the price appreciation of those shares themselves. That's what it means to earn shares in a bear market and earn gains in a bull market. Later, he invested in coal and thermal power stocks using the same logic, focusing on industries that were out of favor, even considered sunset sectors. When their prices fell below book value, their liquidation value, he began buying. He would sell high, buy low, and keep accumulating shares. Through this seemingly simple strategy, he achieved astonishing long-term returns powered by compounding. In stocks, most investors ignored. His success perfectly embodies the essence of low-risk investing. Not chasing overnight riches, but seeking certainty where others see fear and abandonment, and patiently waiting for value to return. The second case comes from a newer and far more chaotic market, the crypto world. I have a friend who currently owns over 1,000 bitcoins. At today's prices, that's worth more than 100 million US dollars. And nearly all of it was earned from scratch, starting with a tiny amount of capital. How did he do it? Not by using high leverage to gamble on direction, and not by going all in on some obscure altcoin. In 2013, when he first got into Bitcoin, the very first thing he did was exactly what Lu Dingong had done: arbitrage trading, or what we call moving bricks. At that time, Bitcoin prices differed across global exchanges because information wasn't well connected, and cross-border capital transfers had barriers. For example, Exchange A might list Bitcoin at $300, while Exchange B sold it for $305. He took advantage of that price difference to earn a profit. Of course, he didn't literally withdraw Bitcoin from Exchange A and transfer it to B. That would have been way too slow. Instead, he kept both fiat money and Bitcoin on each exchange and wrote a program that instantly executed trades whenever a price gap appeared, selling one Bitcoin on the higher-priced Exchange B and simultaneously buying one Bitcoin on the lower-priced Exchange A. This process was virtually risk-free. Each trade earned him just a tiny spread, but it was guaranteed. And his daily goal wasn't to make a certain amount of US dollars, it was to earn more Bitcoin. He thought in Bitcoin terms. By constantly moving bricks, he kept increasing the total number of Bitcoins he owned. Later, as the crypto market evolved, many other low-risk arbitrage opportunities appeared, and he didn't miss a single one. For instance, in 2017, when Bitcoin forked and new coins were created, holders of Bitcoin received one-to-one airdrops, what the crypto world calls candy. Every single time, he sold those free candies immediately and exchanged them for more Bitcoin. It's said that from these airdrops alone, he earned roughly 20% more Bitcoins at zero cost. And even today, With a net worth well over $100 million, his favorite hobby is still studying credit card cashback programs and coupon hacks. You could say that his money-saving mindset has been ingrained in his DNA. What does this case teach us? Even in a market as risky, volatile, and speculative as crypto, there are still low-risk ways to profit. The key lies in your mindset. Whether you focus on finding certainty in value and structure, or gamble on an uncertain future. The final case comes from the real estate market. This investor didn't make his fortune in high-profile, high-priced cities like New York or Los Angeles. Instead, he built his empire in Pittsburgh, a city once nicknamed the Rust Belt for its industrial decline. His approach sounds incredibly simple, almost like junk collecting. He specifically looked for distressed or foreclosed homes that banks were auctioning off at bargain prices. After buying them, he would renovate, sometimes by himself, sometimes hiring others. Here's the key step. Once an old, rundown property was renovated, its appraised value in the bank's system rose dramatically. Then he would rent it out and secure a stable lease agreement. Next, he'd take that now higher-valued house, along with the rental contract proving steady cash flow, back to the bank to refinance. Because the rental income exceeded his monthly mortgage payments, the bank was more than happy to lend. That new loan not only covered the entire cost of purchase and renovation, but often left him with extra cash. And he used that surplus to buy another cheap property, repeating the same cycle over and over. Through this method, he essentially built a massive real estate empire using the bank's money. And today, he owns over 100 houses. What's even more impressive is his risk management. He wasn't blindly expanding. He focused exclusively on the areas around the University of Pittsburgh and Carnegie Mellon University, markets with consistent demand from students. And out of caution, whenever home prices surged, he would proactively sell about 1/3 of his properties to lock in profits, reduce leverage, and wait for the market to stabilize before buying again. This is yet another perfect example of earning chips in a bear market and returns in a bull market. At its core, it's still all about value discovery. Seeing a property's true potential and having the skill to make the market, the bank, and the tenants recognize that value too. After hearing these 3 stories, you might think, that's way out of my league. I can't code and I don't know how to renovate houses. But don't worry, the real core of these stories is the mindset. For ordinary investors like us, we can totally follow a clear investment ladder, step by step, to improve ourselves. Level 1. Treasury reverse repos and money market funds. This is the absolutely safe starting point. It's what I personally did at the very beginning, putting my idle cash here to earn almost risk-free interest. Essentially, in a treasury reverse repo, you're lending money to someone who borrows it with government bonds as collateral, and the exchange guarantees it. The safety level is extremely high. This is your very first lesson in managing cash flow. Level 2. Bonds and bond funds. This is about understanding contracts and credit. Investing in bonds is where you truly begin to understand value. Before stocks even existed, bonds were the main character of the financial world. Whether it's a government bond or a corporate bond, at its core, it's just an IOU, a contract. You need to learn how to evaluate the issuer's credit and judge their ability and willingness to pay back the money. This is the most basic, yet most important form of business analysis. Level 3. Convertible bonds, the hybrid that lets you attack and defend at the same time. Convertible bonds are one of my personal favorites. Basically, it's a bond that comes with a built-in stock option. When the market is bearish or the stock isn't moving, it behaves like a bond, paying you interest and returning your principal at maturity, offering solid downside protection. But when the underlying stock goes up, you can convert it into shares and ride the upside. Super flexible. It's the perfect bridge that helps you transition from understanding debt to understanding equity. Level 4. Value stocks, the never-maturing bonds. Once you really understand bonds, you'll start to see certain stocks completely differently. Companies with stable operations, strong cash flow, consistent dividends, and low valuations, like hydropower stocks we mentioned before. What are they really? They're basically bonds that never mature. You don't buy them hoping for a daily price spike. You buy them for the steady stream of dividends they pay every year, just like bond interest payments. And any price appreciation? That's just your bonus lottery ticket. To invest in these stocks, you need to learn how to read financial statements and measure value with tools like book value and dividend yield, not by chasing rumors or reading candlestick charts. Level 5. Growth stocks. The art of pricing the future. When you're no longer satisfied with the steady interest from value stocks, it's time to move up to growth stocks. With growth investing, you're hoping the company's earnings and your dividends will grow every year. You're buying the company's future, betting it'll make more and more money over time. But this requires much more skill. You need deep insight into business, the ability to tell whether a company has an unbeatable advantage in its field, and how certain it is that its growth story will actually play out. That's real business analysis, and a major leap up the investment ladder. Level 6. Concept stocks and theme investing. The battlefield of human nature. Going further up, you reach the stage most retail investors are familiar with: concept stocks. At this point, you're not investing in a company's actual or near-term value. You're investing in a story that can't be proven wrong yet. Think about trends like the metaverse or nuclear fusion. I'm not saying you can't touch concept stocks at all, but you need to be crystal clear. What you're playing here is a psychological game, not value investing. Your profit comes from someone else's misjudgment. The risk is sky high, and it's not suitable as a main investment strategy for most people. Level 7. Derivatives, futures and options, the double-edged sword of professionals. At the top of the ladder are derivatives like futures and options. For people who truly understand them, these are powerful tools for risk management and hedging, even sources of steady profit. Take Duan Yongping, the founder of BBK, and often called China's Warren Buffett. He's a long-term Apple shareholder. Whenever Apple's stock plunges due to market panic, he doesn't rush to buy the stock directly. Instead, he sells put options, essentially making a bet against market pessimists. He's saying, "I don't think Apple will drop below this price." If he's right and the stock doesn't fall that far, he pockets the option premium, effectively lowering his cost basis. If the stock does fall that low, he ends up buying at a price he already believes is cheap, a perfect way to add to his position. See? In the hands of professionals, options can be a great low-risk income-enhancing tool. But for those who don't understand them, these leveraged instruments are nothing but a gambling table, a wealth destroyer. At this point, I believe you already have a brand new understanding of the bigger picture of investing. Before we wrap up, I want to go through a few of the most common questions people ask to help clear away the last few mental roadblocks on your investment journey. Question 1. If I buy low and sell high to lower my average cost, does that count as a margin of safety? That's a great question. But the answer is probably no. I seriously doubt most people can consistently succeed at buying low and selling high. Because there's a fundamental problem here. How do you actually know what's high and what's low? If you trade purely based on gut feeling, the uncertainty is just too high. You think you're selling at the top, but the price keeps going higher. Do you buy it back at a higher price? You think you're buying the dip, but it keeps dropping. Do you average down or cut your losses? Most people end up overtrading, and ironically, their average cost just keeps getting higher. What I talked about before, like arbitrage between similar companies, that's not subjective buy low sell high trading. It's a value-based arbitrage grounded in objective comparison between two similar businesses. That approach has a much higher success rate. So the real margin of safety comes from buying at a price that's well below your estimate of intrinsic value, not from trying to predict short-term market moves. Question 2. Value investing sounds great, but what if my value estimate is wrong? Or what if the stock price never goes back up to its intrinsic value? That's a key question. How do you manage uncertainty and risk? The answer lies in two words: probability and position sizing. Nothing in this world is ever 100% certain, not even value investing. That's why you can use something called the Kelly formula as a decision-making framework. Simply put, it helps you size your position based on the probability of success and the risk-to-reward ratio, how much you could gain versus how much you could lose. If you believe an opportunity has a 90% chance of success, and you could triple your money while losing at most 30% if you're wrong, then you can go in with a larger position. But if something has only a 10% chance of working out, and even if it does, the upside is just 10%, while the downside could be an 80% loss, then it's obvious you should stay away. Managing your position size to handle the uncertainty of value, that's the key difference between a professional investor and a gambler. Question 3. What's my real risk preference? How high should I climb on the investment ladder? To answer that, you need to revisit those questions from your risk assessment: your age, your family situation, your income, and your debt level. Together, these determine how much risk you can truly handle. I've seen many middle-class friends with stable jobs and happy families put most of their savings into high-risk short-term speculation. Let's do a quick risk-reward analysis. Even if you gamble with a few million yuan and double your money by pure luck, would your life really change in a meaningful way? Probably not. Maybe you'll just buy a nicer car or spend a little more freely, but your social status won't really improve. However, if you lose half or all of it, you could fall from middle class to lower class, or even poverty. When a game offers limited upside but massive downside, why would you even play it? So, be very clear about what you truly want. If you're young and can afford to lose, use a small amount of money to climb faster and experiment more. But if you've already built a family and have people depending on you, then most of your assets should stay on the lower, more stable rungs of that investment ladder. Today, we started with a bold idea, revisited the true starting point of investing, shared real stories from 3 investment masters, and built an investment ladder that takes you from beginner to expert. Let me emphasize this again. The essence of investing is not predicting markets, and it's definitely not gambling. Finance is not some kind of scam the public game. Real investing is a process of discovering value. As an investor, you're putting your money into businesses that actually create value, supporting the growth of the real economy, and you deserve the returns that come with that. Starting with low-risk investments is meaningful because it helps you develop a clear understanding of value right from the start. Your feet are planted firmly on solid ground, not floating in the clouds of speculation. So if you ever feel lost, anxious, or deeply frustrated with investing, I suggest you take a step back. Pick up a timeless classic like Security Analysis and return to your beginner's village. Start your journey to wealth again, from the simplest, most fundamental, and most powerful place. That's it for today's video. I hope it brought you some real insights. See you next time.